We wanted to talk about the sort of the global markets, the UK market, Brexit. But listen, you've got protests in the UK months ago, obviously, over Brexit. They might start back up again. Growing unrest on mainland Europe. Now you've got this in Hong Kong. Is there a way to price in the cost of unrest at all?
So to some degree there is, which is its higher risk. If you go back 20, 30 years, we were used to political, not unrest, but political disruption to be part of the equation for investing. And then we got used for a long period in which the world was stable and everybody was growing together, notwithstanding the 2008 crash, right? Because essentially that was not based on political disruption. Increasingly, we've seen political disruption, and political disruption hits in two ways. One is you have protest, which actually gives instability, but the other one is it can change regulation, and that is what can matter.
In a good or bad way, or both?
It can be in both. I mean, to some degree, even in this great country, the fact that there is some tension between the executive and the Fed, for example, is a way of dealing with this political unease about how the growth is being distributed on everybody within the country. As an example, the same you go in Italy, the fact that there's this unease about immigration. In Hong Kong, they don't like the fact that they're being brought tighter into mainland China, and particularly in this case, the extradition laws. So all it says is, be aware that there is more disruption likely. It's like any other kind of volatility. You price it in, and the price is an increase in risk premium.
Well, you've got an investment team there in London. You are majority owned by US-based Federated. So you're dealing with clients. They call you guys and your team up and say, I'm nervous about this. Should I sell stock? Should I be invested? When the world is angry.
So our answer is, it's about time horizons. Our clients, by and large, are very long time horizon clients. And when we say to them, mostly short-term volatility does not affect the long-term. Sometimes it does, mostly it doesn't. It's opportunity. So what we say is, don't lose your nerve because of the short-term volatility. Just concentrate on what you're doing. So, but understand, if you go into developing markets, it's not the same as investing in the United States or in mainland Europe. It is more volatile. So expect the volatility to come more. If you're investing in the United States, it's stable, but the growth is not going to be as great. Understand that there is a trade-off, right? And as long as you know that and you're prepared for it, you can ride the volatility.
If we get a hard Brexit, does the UK fall into recession?
So if we get a hard Brexit, I think the UK will slow down quite a lot. And I know that there are many people who disagree with this, particularly those who we call hard Brexiteers. I don't say this from a political point of view, it's just the numbers. The numbers are the numbers. Look, the reality is both sides have become almost religious about it, but if you look at the maths, the chances are you have a reasonably severe slowdown because of the disruption of a hard Brexit.
Quickly, what is the most important thing on your radar right now?
The most important thing on my radar right now is what happens to growth in the United States, because that is the big engine, and whether the United States and China come to a trade deal.